Good afternoon, ladies and gentlemen. Welcome to our conference. We had a big sign up for this conference. I'm from Chicago, you know, and it doesn't seem that cold out there to me. But in the with all the softies in Washington, some of them haven't turned up. Thank you for being here. I am Alex Pollock of the R Street Institute, and Paul Kupiec and I are very happy to welcome you to our discussion today on the topic, can unorthodox monetary policy make America great again? The original working title for our conference when we were first thinking of this was Negative Interest Rates and Other Central Bank Experiments. And now what's remarkable is that these experiments have gone on for years after the crisis ended. It's 7 years since the end of the panic, and we still have amazing central bank unorthodox experimentation going. For 8 years, interest rates have been at near zero levels, at levels which previously we would have said were impossible and couldn't happen, and if they did happen, certainly couldn't last 8 years. Many people used to think that there was a so-called zero bound to interest rates, which meant that nominal interest rates couldn't go below zero. We always knew real interest rates could, but nominal interest rates. Of course, now we've had in the world trillions of dollars of securities with negative interest rates. Now, thinking about this experimentation and its very long lasting time, I think it's fair to ask ourselves, do the central banks, including the Fed, but also other major central banks, do the central banks know what they're doing? Meaning, do they know what the results of this experimentation will be? And my guess is that they don't. And moreover, they can't, because no one could know that. And the central banks are flying the unorthodox monetary policy airplane by the seat of their pants. Now, as we know, yesterday the Fed raised its target short-term interest rate by 1/4%. Big deal. Interest rates are still extraordinarily low, with a short rate of 0.75% in a, let's say, 2% inflation. That gives you a negative 1.25% real short-term rate, substantially negative. Going into 8 years past the end of the crisis. The Fed said it expects 3 more increases of 0.25% each next year. That'd be in total 0.75%. That would take short rates to 1.5%. In a 2% inflation, if inflation would stay there, you still have a negative real interest rate of 0.5%. And I think perhaps Dick Silla can correct me on this, but if not a world record, at least an extremely world competitive range of the duration of negative real interest rates. And so-called QE, or Fed bond buying, is not over. We often read how the Fed ended QE. They didn't, because they keep buying to top up their portfolios of long-term government bonds and mortgage-backed securities as they either mature or prepay. So they're still in there buying as a big bid and affecting the long markets. Now, what has all this monetary experimentation brought? What will it bring going forward, and what should be done going forward? All that, of course, the panel will tell us. Here's a final opening thought. I think we should do a stress test on the Federal Reserve. Now, the Fed's aggregate balance sheet is about $4.5 trillion in assets, and their total capital is $40 billion. This gives them a leverage capital ratio of 111 to 1, or a capital ratio of less than 1%, 0.9%. Now let us suppose that long rates rise 2%. Of the Fed's assets, 4.3 trillion are long bonds and very long mortgage-backed securities. We don't know what their duration is because the Fed doesn't tell us, doesn't disclose that, but suppose, you make a really conservative guess and say it's a 5-year duration. That means with a 2% rise in interest rates, you get 2 times 5%, that's 10% depreciation in market value. On 4.3 trillion, that's $430 billion market value loss. And if your capital is $40 billion, that's 10 times your capital in market loss. So I think it makes an interesting stress test on the Federal Reserve itself. Now, how do we think about all this? How do we frame it? How do we imagine how this might continue to unroll? And our panel is going to help us do that. Now, you will have noticed that our colleague Jim Grant is not here. He unfortunately got quite ill and couldn't make the trip. However, he has provided me with comments which I will deliver on his behalf. And he also sent down the current copy of Grant's Interest Rate Observer, which, if you don't know it, is always a read that's very fun, very witty, and insightful at the same time. So those are out there if you would like to take one. And at Jim's place on the panel, which is at the end, I will deliver some comments of his. We're going to have opening comments from the panel and give the panel a chance to respond to each other or clarify their own comments or add comments. We'll then open the floor to your questions, and we'll adjourn promptly at 5 so that you can drink another hot cup of coffee and then venture back out into the cold wind. Let me introduce our panel. First will be Dick Silla, who is the Henry Kaufman Professor of the History of Financial Institutions and Markets at New York University Stern School of Business. Among Dick's books are the revised classic A History of Interest Rates, which I know he's going to be using today in his comments. This long history that Dick has explored has never before seen the negative interest rates of recent times. Dick has served as president of the Economic History Association and the Business History Conference. He's the chairman of the Museum of American Finance. He is also a fellow of the Cliometric Society. Now, for those who, unlike me, may not have been literary students, I will let you know that Clio is the muse of history, therefore Cliometric. However, Dick, I don't think the Greeks had a muse of finance. But like us, they borrowed and lent and debased their money. Next will be Paul Kupiec, a resident scholar at AEI who brings his iconoclastic insights to the study of banks and financial markets, including issues of systemic risk and the impact of financial regulations on the U.S. economy. Paul was previously director of the Center for Financial Research at the Federal Deposit Insurance Corporation, chairman of the Research Task Force of the Basel Committee on Banking Supervision, and held positions at the IMF and Freddie Mac and J.P. Morgan and the Federal Reserve, and he is the co-organizer of this conference. Then Desmond Lockman, who's been a resident fellow at AEI since 2003, focused on the global macroeconomy, and the global macroeconomy has given Desmond plenty of things to work on in those years, including financial crises, the U.S. dollar, ongoing strains in the euro area, the continuing debt crises of Greece and Puerto Rico, international economics, including more recently the very stressful travails of Italy and its financial system. Desmond was previously with Solomon Smith Barney and the International Monetary Fund, and his recent research includes the global mispricing of risk and therefore the increased systemic risk resulting from the major central banks' experimentation. Here by proxy is Jim Grant, whom I will represent. Jim's biography begins with the sentence that he was born in 1946, the year interest rates put in their 20th century lows. He founded Grant's Interest Rate Observer in 1983, 2 years after interest rates recorded their all-time highs. And now if you think of the period from 1946 to now, That's 70 years. There have been lots of changes in interest rates, to be sure, and in the financial system and in financial institutions. But one of the things I know Jim would stress and I would stress is that the guiding ideas of central banks and of the Fed have changed notably several times in that period. And the ideas or the beliefs of central bankers are among the most important factors in modern financial systems. So there's our panel. And Dick, so glad to have you with us, and you have the floor.
Thanks, Alex. It's good to be here at AEI on a cold day. And I'm sorry that Jim isn't here. 2 days ago, I met Jim on the street. That's street with capital S, meaning Wall Street. He hangs out at 2 Wall Street. That's where Grant's Interest Rate Observer is, and I hang out at 48 Wall Street, which is where the Museum of American Finance is. And I happen to be stumbling up Wall Street because I have a bad left foot or ankle, and I have a bum right knee, among other maladies. And Jim happened to be coming out as I was heading for the subway toward Trinity Church. Jim stumbled out of 2 Wall Street, and we both limped our way up to Broadway. And I said, Jim, we're going to be in a panel in D.C. in a couple of days. Here we're both limping. And he said, I have this terrible attack of sciatica. And I said, what do you think? I have the bad ankle, I told him, and I have a bad knee. And Jim said, I think I know that I can diagnose what our problem is. And I said, what's that, Jim? He said, too many birthdays. We're getting old. Well, I made it down here, limping my way from New York, and Jim couldn't make it. But he looked maybe in worse shape than I am. As I looked up to him, Jim's about 6'4", and I'm about 4'6". So, but we've been great friends. Even though Jim is he's an Adams man, John Adams. One of his books, not his most recent book, but one of his books is about John Adams, called John Adams' Party of One. John Adams is a bit of a curmudgeon, and I think Jim Grant's a bit of a curmudgeon, so he really liked John Adams. And I am a Hamiltonian, which reminds me, this is shameless self-promotion now, I have just published a book, out a month, Alexander Hamilton, the Illustrated Biography. And Paul Kupiak and I were colleagues down at North Carolina State a long time ago, and I brought along a copy for Paul. And so I'm going to surprise him here by giving him that copy.
So nice. Thank you.
The problem with the book is, it's called The Illustrated Biography. I wrote the text, and then the illustrators took persons, places, and events and got pictures for them. And now everyone says, it's such a beautiful book, nobody's reading my text. They're just looking at the pictures. So, but it's much shorter than Ron Chernow's biography. So if you're interested in you don't have time to read Chernow's 800 pages, there's a much easier one to read. All right, into my talk, which, is this going to work now?
We hope so.
Yeah. I don't know how much I can see this. I'm going to stand up a little bit and be like a business school professor.
It's a great title, Dick.
Well, yeah, and Jim picked up on this, and back in the fall, he called me up on the phone and he said, have interest rates ever been this low? And because I co-authored this history of interest rates, and I said, no, they've never been this low. And then he started writing about that in Grant's Interest Rate Observer. So I thought, since there's interest in that, I thought we would take a look. Are these interest rates the lowest ever? Whoops, what did I do there? Okay, here's my agenda. Establish that recent interest rates and bond yields are the lowest in 4,000 to 5,000 years of recorded history. Identify when some previous lows occurred and compare them with now to see some similarities. And I'm a financial historian. I'm an economist, but my specialty is financial history. And lots of times we like to look at analogies. Like we may easily think, gee, we're in terribly uncharted waters here. Nothing like this ever happened before. Unorthodox monetary policy, zero interest rates. But maybe that's not quite so true. But I'll speculate a little bit on the future path of interest rates and bond yields. All right, here you have the ancient world. By the way, these charts come from a history of interest rates. Which I think is still available. This is the ancient world, and we have Babylonia. Whoops, I've got to press the wrong button there. Babylonia, doesn't work much better. The little pointer doesn't work that much. Anyway, if you can, let's see now. Let's get back to Babylonia. Yeah, there it is. Babylonian interest rates over on the left, and the lowest they ever got was about 10%. And 20%, that was kind of on cash loans. People lent grain in Babylonia, and the interest rate on grain loans, we get this, by the way, from the Code of Hammurabi, which some of you may have heard of. The Code of Hammurabi says if you lend somebody a bushel of grain, he has to give you 1 1/3 bushels of grain back next year. That's 33% interest rate. On cash loans, though, it's specified 20%. So we have 20%, and it goes down to 10%, then it goes up again. Ancient Greece, it looks like it starts out between 15 and 20% and gets down to about 6%, and then it starts going up again. And then Rome looks like it starts out between 8 and 10%, gets down to the low here. You might look like zero interest rates, but you have to look over and see that that's really 4%. The horizontal axis is at 4%. So in the ancient world, the Romans got interest rates to around 4%, but then they go up again. And it's around from 100 BC to 100 AD or 100 CE, so somewhere in that range at the time of Augustus and so on. Maybe the height of the Roman Empire, or early on, that they got down to 4%. There's a U-shaped pattern. And it seems that the low interest rates usually come up when what's considered the high points of any one of these civilizations. And so they go down while the civilization is improving, and they go up when the civilization is declining.
Dick, you have 100 years of 4% rate, so aren't we a little bit going overboard when we talk about the 1990s as the Great Moderation?
Could be, but remember, these are not daily data. You find a rate here. Maybe there's 50 BC, somebody made a loan at 4%, and then 50 CE, somebody made a loan at 4%, and there were no observations in between. But anyway, so there's a feeling that the low interest rates come at the height of civilization, and then when things go bad, when the barbarians creep in on the Romans, things get worse. So that tells us that we are at the height of American civilization now, and maybe world civilization, because we have these very low interest rates. So it's just going to get worse from here on, right? All right, that's the ancient world. Let's see. No, I'm not moving. Do I have to point this in some particular direction? There we go. This is another chart. Long rates from 1200 to 2000 Common Era. Declining trend. There's a kind of long-term trend down. If you study the chart, you can't absorb all this right now. So you have two alternatives. One, you could go out and buy my book. Number two, if you could email me, arcilla@stern.nyu.edu, I'd be glad to send you a copy of these slides.
Will these may be on the AEI website?
Or you can put them up there if you want.
We'll add the slides to the website, so you'll have them.
Anyway, so there's a lot of, but when you see N there, that means maybe in the Spanish Netherlands rates were the lowest rate. These are the lowest rates that prevailed at any time. So back in the 13th century, maybe the Spanish Netherlands and Italy shows up a lot. The I is for Italy. Spain has low rates in the 15th and 16th century. Germany, Netherlands, and Italy. The H is for Holland, and they have some of the lowest rates in the 17th and 18th century when Amsterdam was the financial center of the world. Then the English come in there. There's some low rates there in England, usually a little bit above the Dutch. And English rates by the 19th century become the lowest. And in the early part of the 20th century, and even to the middle of the 20th century, the US had the lowest rates, but in the latter part of the 20th century, Switzerland, that country of financial responsibility, they had the lowest interest rates in the world. But you see, there was a declining trend until about the middle of the 20th century when the US rates were low, and then there was a rise with the inflation of these are kind of nominal rates, so not real rates. Keep that in mind. These are long rates. Short rates, something similar story. Well, let's go back and see. About the lowest long rates got it was between 2 and 3%. Now, when we look at short rates, similar story. Sometimes they're higher than long rates, actually. the same countries, generally the Netherlands, Italy, England, Holland and England, and then you get the US down. And here you get between 0.5% and 1% in the, and I'm going to come back to that later on, but in the 20th century, in the early 20th century, US short rates got as low as somewhere between 0.5% and 1%. And these would be decennial averages, so it's not exactly highly granular data. So moving ahead, I want to point out that we see that rates and yields fell from 1865 to 1899, similar to the period we just came through, 1982 to 2016. Rates reached some high levels at the end of the American Civil War, the 1860s, and then they come down for 30 years or so in the 1870s, 80s, and 90s, and that's the pattern we've been through since around 1980 to the present. Moderately rising trends take place too after the 1899 lows. This is 1900 to 1899 to 1920. We get a gradual increase from low levels. The low levels there were around 3% on American corporate bonds, a little bit above 3%, and you get a gradually rising trend. I think something like this is what's going to be in front of us now. And the question is, how fast will rates go up? But Jim Grant is fond of pointing out that when he was born, the rates were low, and they went up for 35 years. By the time Jim was 35, it was 1981. Interest rates had risen for the first 35 years of his life. They hit a great peak in 1981, and they've come down as 2016, 35 years later. And if you believe in numerology, it's time for interest rates to turn around and go the other way.
For 35 years?
35 years, right. Who knows? But anyway, this was 20-some years they trended up from the lows of the late 19th century. And so they do go up like that. Whoops, what did I do now? I hope I didn't miss one. Here's U.S. short rates, 1900 to 1945. And what I want to talk about here, this looks pretty funny. You get, things look sort of normal, 4 or 5% in the 1900 to 1930. Then in the 1930s, you get a great big drop in interest rates, such as we have seen 1929-41 pattern. Might remind you of the last decade when interest rates really went down a lot. And there's long yields from 1920 to 1946. Here again, does the decline from 1930 to 46 remind you of recent years? I think we should think that everything isn't totally different from what it was in the past, that these interest rates, there's a pattern of really declining to very low interest rates, and this is corporate bonds. You get between 3 and 2%. Whoops! When I try to get the red thing to show, it doesn't work very well. You could get a period like we've been through, say from the early 1930s to the end of World War II, rates tumbled a great deal, just like they did in recent years. Now here's the interesting times in which we lived. Jim Grant was born when the previous rates were almost all-time lows in U.S. history in the 1940s. And then they went up to the highest rates in U.S. history. And then they've come down in our own time over here at the right end to these really low rates that we've experienced. And so from the highest to the lowest, in my adult lifetime, we've had the highest and the lowest interest rates in all of U.S. history. I think so we can say we lived in interesting times. Now, yields should rise in an economic recovery like we've had lately. And I say think again, this is from the Fed, the database at the Federal Reserve Bank of St. Louis, or is it the Fed itself, I guess. What's interesting to me is in our so-called recovery of recent years, so there's sort of a peak there in 2013, early 2014. The recovery supposedly went on from then to now, but the rates went down. This is unorthodox monetary policy, I think. That explains it. The title of the panel today is something about unorthodox monetary policy, and I think it's, instead of rates going up in a recovery, they came down for the last couple of years. So that's unorthodox. The lowest previous rates now, everything isn't so unprecedented. If you go back and study the late 1930s, And I wasn't born until the 1940s, so is there anyone here who remembers the late 1930s? I doubt it. But you do see at the end of the 1930s, annual average 3-month T-bills from 1938 to 1941 were 0.5%, 0.2%, 0.1%, and then in those four, it went up to 0.1%. So it's not unprecedented to have the kind of rates we've seen, even in our own history. Bond yields continued to decline through World War II, but that was because the Treasury more or less pegged interest rates. Now, 33-41, I'd say this is my historical analogy would be, if we look at the last 8 or 9 years, it's kind of similar to the 1930s. Each one begins with a crisis, followed by a slow, halting recovery. The 1930s recovery was slow and halting. And basically, the U.S. economy just sort of returned to pre-crisis levels of GDP per person. So that's a similarity between the 30s and recently. You may not know this, but the Federal Reserve balance sheet quadrupled from 1932 to 1941, something similar to what it did in 2007 to 2016, a quadrupling of the Federal Reserve balance sheet. In both periods, the banks of the country, sort of shell-shocked by the crisis, greatly increased their excess reserve holdings. And I would say in both of these periods, a low demand for credit coupled with increased supplies from the Fed to reduced interest rates to very low levels. So I'm making an analogy there that we have not lived in unprecedented times. There's something similar happened in the 1930s. I think this is my last slide. Secular stagnation, new normal of low growth. These same terms, especially secular stagnation, were heard in the 1930s. They turned out to be wrong because World War II changed everything. We don't really want World War III to pull us out of our current malaise, I guess, but there could be a more peaceful equivalent. Many were saying that massive infrastructure spending program is needed and feasible, and all it requires is the political will and leadership. President Trump, he's talking about a big infrastructure program. So infrastructure spending is the moral equivalent of war, I guess. World War II changed things in the previous period of low interest rates. Now maybe it's going to be infrastructure. If we get a program like that, interest rates and bond yields likely would move back to normal levels, as happened before. And I gave you a couple examples, 1899 to 1920. Didn't emphasize it so much, but also from 1946 to 65. There was a couple decades where interest rates moved from very low levels to normal levels. And so I would say in the one closing point would be that our time may not be as unique and unprecedented as some think it is, but in terms of the title of our program today, I would have to say that unorthodox monetary policy of the 1930s did not make America great again. World War II did. And I think about the recent period, unorthodox monetary policy from 2008 to 16 has not made America great again. But we can talk about what might make America great again. Thank you very much.
Thanks, Dick. Paul.
Thanks a lot. Very interesting. Does it just come up? Oh, there we go. Okay. So I'm going to talk about my views about whether unorthodox monetary policy is really working. So as Dick showed you, many countries have had bouts of low interest rate in the past, and just to think about one recently, I mean, we've had them since late 2008, but Japan's basically had near zero interest rates since the mid-1990s. And so, I mean, low interest rates have become routine in a lot of places around the world. Are they working? Let me show you again that Japan has had them for 20 years. So, but just to go back and to think about the problem, I think a quote from a former AEI person on our scholar boards, Milton Friedman, famously testified that because monetary policy operates with long and variable lags, it is so difficult as a technical matter in our present state of knowledge to know what measures one ought to take in any given time. And I think 60 years after his testimony, I'm not sure if anything much has changed. In theory, low interest rates are supposed to stimulate demand. Consumers are supposed to save less or spend more. The flip side of that, interest rates fall. They fall lower than the consumer's rate of discount for consumption. And instead of waiting to take that St. Kitts and Nevis vacation in July, you'd sure rather take it tomorrow, right? I mean, it's going to be, the weather's right, and the interest rate isn't going to, the investment that you'd make on that money isn't going to keep you from taking the trip. So you move consumption from the future into today. You buy houses, cars, household appliances, vacations. Firms increase their investment spending. It's much cheaper to borrow for plant and equipment and software. And if you just come out of your MBA class, they tell you should corporations undertake projects that have positive net present value. And the thing we teach in business school is you should discount the cash flows on your investment at your sort of average cost of funding for that project. And so as interest rates fall, more and more projects should have positive net present value. So there should be a whole bigger menu of things that firms want to invest in as interest rates fall. But does monetary policy work that way? Well, I think it's maybe appropriate here to maybe recall what one of our famous American philosophers, Yogi Berra, reminded us of. In theory, there's no difference between theory and practice. In practice, there is. So let's look a little bit at the practice of unorthodox monetary policy. So unorthodox monetary policy has large redistribution effects. It has a huge impact of those living off their savings. Just for example, in 1990, if you had $1 million and you bought $1 million invested in 10-year treasuries, you get $82,100 in income a year. Now, so basically, if you had a nest egg of $1 million and you put it in safe treasuries, you could live pretty comfortably, off of. And in 1990 dollars, $82,100 went a lot farther than it does in 2016 dollars. But if you wanted to generate that same amount of nominal income today, you'd have to have almost a $4 million treasury portfolio. So you'd have to have 4 times the savings to generate the level of income. And on top of that, if you invested in 10-year treasuries, you'd be taking huge interest rate risk at this stage of the cycle. So if interest rates follow the pattern that we think they might, you'd have huge exposure to interest rate risk. So you'd have to have a lot more invested, and you'd have to expose yourself, even in treasury securities, which are default risk-free. You'd have to take a big interest rate risk position to generate the same level of income. So savers are forced to either hold safe assets like bank accounts or money market funds that yield virtually nothing, or they have to invest in risky assets to generate income, buy stocks, take a bet on a long-term interest rates not going up if they want to get some yield. Target savers must have to save more, not less. In today's environment and these super low interest rate environments, if you think about it, savers face some really bizarre trade-offs. Say you have some money at the end of the month. You could save it. Well, what could you do? You could put it in a bank account and you could earn 11 basis points annual percentage rate. That was the annual percentage rate on a money market account, the highest yielding account at according to bankrate.com on Tuesday. Or you can open a credit card account and earn 3% back on all your purchases, right? So if Bank of America pays you virtually nothing to save your money, but it'll pay you 3% to spend your money. I mean, this is a pretty bizarre state of affairs, and I don't think they had that in Rome, did they, Dick?
Not that I know of.
So it's even a little stranger. So you have to spend it all on gas to get 3%, but still, I actually spend a lot on gas driving back and forth. But anyway, that's a pretty strange trade-off if you think about savings and investment. I get paid more to spend my money. I get more back in my rewards on my credit card than I do on my bank accounts. That's pretty strange. That's unorthodox monetary policy. It's made borrowing incredibly cheap. So what do people do? They refinance old expensive debt with new cheap credit. That strengthens the balance sheets of households and firms that do this. That's a good thing, okay? That allows households and firms, the ones that can have access to credit, to strengthen their positions after the last financial crisis But the growth impacts or the benefits of that are limited by the increase that you have to make if you're a target saver. If you have to reach some goal to retire, you got to save more. That cuts back on the benefit. Reduced income for retirees, and weak households that have weak balance sheets or corporations that have weak balance sheets aren't going to have access to this cheap credit. And so you're going to have a sort of a separation effect there, that the people that are creditworthy are going to do better on the refinance side than those that aren't. Firms and households are borrowing, but are they borrowing for new consumption and investment spending? And so we're going to look at this a little bit. So if you look at the household debt figures for the U.S., flow of funds numbers, you can see that this is the growth rate in total household indebtedness, the total household borrowing. And it was quite high in 2006 and 2007 leading up to the crisis. Borrowing was essentially zero in 2008, zero or negative for the next few years, but it has recovered. It has recovered in the last few years, but the growth rate of household indebtedness is actually much slower than the growth rate in GDP. So if you actually look at the household debt to GDP ratio for the United States, it's actually come down. It's come down quite a bit since the financial crisis. So households have been borrowing, but to a far lesser extent. So the low rates aren't stimulating a lot of household borrowing here. How about the corporate side? Well, there's the quarterly growth rate in U.S. non-financial liabilities. And you can see they were really high on the left there before the crisis. They sort of tanked in 2008, and they've recovered somewhat, but they're not extremely high compared to history by any means. And if you actually look at the non-financial corporate total liabilities to total assets, they've actually come way down from the peak and are pretty flat. So corporations, on balance, compared to their asset values, aren't putting on a lot of new debt, even though they face these ultra-low interest rates for borrowing. So who has been stimulated by whose borrowing has been stimulated? Anybody want to guess? There you go. There's the federal total public debt as a percent of GDP. That's the missing piece. That's what's growing. That's who's borrowing is the government, and by a long shot. We were about 65%, say, back in 2008, and now we're up over close to 105%. So we've really put on. The government is the chief person taking advantage of these low interest rates, or the chief. So I want to take a brief tour of unorthodox monetary policy around the world and sort of look at some countries I can get data on and say, what's been the effect on consumption and investment and savings. So have ultra low interest rates, have they really reduced savings? And it turns out no, they haven't. So another way to ask that is, have they increase consumption? And the answer is no, they haven't increased consumption because they haven't depressed savings. And in many countries, the low rates have actually caused the household savings rate or have been associated with increases in the household savings rate. Now I'm going to take my tour, and I'm not going to sort of read the fine tea leaves. I'm going to more look at banana-sized leaves here. I'm going to read the details and kind of leaves on the banana tree, kind of the big picture. So here's the Danish interest rate, benchmark interest rate. You can see it's come way down since 2008. It's been negative since 2015. That on the far right-hand side, it's actually well below zero. And you can see over the last few years, the savings rate in Denmark has actually increased quite a bit. So under these negative interest rates, savings are actually going up, not going down. That's exactly, as Yogi Berra would say, theory doesn't work out the same way in practice. It's not working out the way we thought. The Swedish interest rate, there's the benchmark interest rate for Sweden on the top. Also negative interest rates since 2015. You can also see their savings rate in the last few years is up, not down. Here's the Switzerland benchmark interest rate, which also has negative interest rates of 75 basis points currently. And you can see the savings rate hasn't really budged. It's moved up a little bit, moved down a hair, but it's basically very strong. So the Swiss are not cashing in their savings and spending their money because the interest rates are negative. Japan, it's a sad case in a lot of ways. They've had basically zero interest rates or close to zero interest rates virtually for 20 years, and the savings rate, they've gone negative since 2016, and the savings rate is actually up in Japan. U.S. benchmark interest rate, again, that's come way down, as we all know. It's blipped up recently, but the savings rate in the U.S. has been strong the whole entire period. So if we think about the effect on savings, there's no evidence this super low interest rates or negative interest rates has really had a huge impact on how people save. If anything, it seems like they've caused people to save more, not less. Have ultra low interest rates actually generated outside gross domestic investment in these countries? And the answer is no, and we'll take a look here. Here's the Danish case again, and we have super low interest rates again, but the gross domestic investment in Denmark is fairly modest. It's on pace with GDP growth. It's nothing special. Japan, similar story. No real boost in gross domestic investment. Switzerland's the same story. In the U.S., it's pretty much a similar story too. It's gross private domestic investment has been weak despite the low interest rates. Weak for a recovery period. So why isn't the investment impact so small? Lower interest rates will reduce the firm's cost of capital, and there should be a lot more projects that have positive net present value if they're actually discounting all the cash flows these projects, these investment alternatives generate in the future. There ought to be a lot more of them that they want to invest in. So if you think about that, you ought to have more investment. This is the way the Federal Reserve has worked and thought for years. And in fact, one of the main channels of monetary policy in the 1990s was lower interest rates spurred mortgage refinancing. Consumers would get money out of their house and use their house as a piggy bank and spend more on consumption. And that was kind of a big part of the Fed's assumed transmission mechanism in the 1990s. And here, the firm mechanism is the traditional one. But there's an alternative view of the way that things might work. So many firms, it turns out, if you ask them how they decide on what to invest in, they say, well, we invest in things that return greater than our board set target rate of return. Okay, so the board sets some minimum target rate of return that an investment has to meet, and they can't invest in it if they don't meet that target. These corporate hurdle rates tend to be very sticky over time. They don't change when the Fed changes interest rates. So basically, the more corporations that follow an approach like this, the harder it's going to be for lower interest rates to stimulate investment spending, because the hurdle rates don't change. The fewer projects, it doesn't affect, the lower interest rates don't affect the number of projects that look like good investments to firms. So 15% turns out to be a popular hurdle rate target at a lot of firms, according to survey evidence. And in fact, when I worked at Freddie Mac in the 1990s, that was the policy. Everything had to make 15%, or you couldn't invest in it. It was the board policy, so I've seen it firsthand. And so evidence suggests that these targets don't change. And my experience at Freddie Mac was they didn't change either. We had the Russian financial crisis and the failure of long-term capital, and interest rates came down, and they didn't change the target rate at Freddie Mac when I was there. So, I mean, these things were actively discussed too. So the hurdle rate approach is important in practice. There's some academic studies that show, and some recently the Fed is starting to look into this more and more, but there's a bunch of finance papers in the literature that show that this is becoming a more important topic in the literature. And here's some new evidence I'm working on longer term. I'll give you a brief little snippet. So if you ask yourself what we should expect to see if corporations follow the traditional approach and accept projects with lower expected rate of returns as the interest rate falls, well, we would expect their return on assets, if we could measure it with accounting data, we'd expect that if you had a really long period of low interest rates, you'd expect the return on assets of the firms to get smaller over time, because they'd be adding projects that had lower and lower return on assets. And if the interest rates went on long enough, you'd expect their average return on all their assets to be pulled down over time as they added these investments that had lower rates of return, because if that's the way they worked, if lower interest rates led them to take on more and more projects, and even the ones that had lower rates of return, that's what we ought to see. So I'm going to look at the actual performance of a few industries and see if that pattern actually emerges. So this is, there's about 6,000 firm data observations here. This is the fabricated metal products industry. And if you look over time, this is earnings before interest and taxes. So it's kind of like cash flow before depreciation and taxes. And it's divided by the assets of the firm. And for every year, we average the assets of the firm. And over the low interest rate period, 2008 to 2015, you don't really see any particular pattern. It looks like the pattern that existed long before the unorthodox monetary policy. So there's no real strong evidence in these numbers here that firms are pushing down the ROA on the projects, on the margin they take, since interest rates have been ultra low. So it kind of makes you wonder about the credibility of the kind of traditional story about using the average cost of capital and taking on positive net present values. Here's another manufacturing industry, and you can see over the last few years the actual proxy for the return on assets has gone up, not down. It should have gone down if the traditional view is right. It's actually gone up. And here's another industry. There's a little evidence it tails down in the end, but there's no systematic pattern that I see here. So it's a little bit of work I'm doing where we pull actual accounting data from CompuStat for many, many industries and try to control for the stage of the economic growth, and then look and see if we can discern whether there actually is a pattern between real interest rates and or nominal interest rates and the rate of return on the return on assets that firms have. So, great. Thanks.
Boy, good job.
Thank you, Desmond.
Got me trained.
Thank you, Alex, and thank you, Paul, for arranging this. I guess I'll take a somewhat different approach, and I guess I've got a different view of the world. But let me just start by addressing the question at issue: can monetary policy make the United States great again? My answer would say is that monetary policy is a necessary condition, but not a sufficient. By far, it's not a sufficient condition. So if monetary policy messes up, you can be sure that America is not going to become great again. And I'd say that in two senses. The immediate sense right now is monetary policy is going to have to be sufficiently restrictive to offset what looks like it's going to be an expansionary fiscal policy. So the Fed is in a really very difficult position right now. You've got an incoming administration that has a different view, a different approach to economic policy. They think that if you're practically at full employment, a good idea is to cut taxes by huge amounts, both on the corporate and the household side, and at the same time to increase infrastructure spending and defense spending, which is really going to put a lot of pressure on inflation. Considering that you're at close to full employment, it's going to really force the Fed to raise interest rates. And what we've seen already is markets are anticipating that. The 10-year bond, I noticed on the chart put up there, the 10-year bond is already at 2.6%, which is a high that it hasn't seen for quite a while. So in that stage, one's really going to have monetary policy being restrictive. My view, which I'm going to elaborate right now, is I don't think that we are returning to high interest rates because of past monetary policy mistakes, because of this unorthodox policy. I believe that what we're going to see is we're going to see bursting of credit bubbles. We're going to see the need again for another round of unorthodox monetary policy. And my hope is that we've learned from the past mistakes and that we don't repeat what we've done in 2008 onwards. So let me just summarize, what's occurred is we've had monetary policy the likes of which we've never seen before. That the Fed quintuples its balance sheet more or less. It's joined by a whole bunch of other central banks. What you've also got is experimentation with negative interest rates. You've got forward guidance. This is a whole new world. The real policy that is different is the quantitative easing side. So just to illustrate that with a few slides, this just reminds you of the Federal Reserve. What they did is it took them 100 years to get their balance sheet to 5% of the United States GDP. It takes them only something like 6 years to push it up to 25%. That is huge. You're talking about going from $800 billion to something like $4.5 trillion in a very short space of time. This is accompanied by central banks around the world doing more or less the same thing, taking a little bit longer. Something like the ECB comes in relatively late in the game. but the bottom line is that the balance sheets of the world's major central banks have increased from something like $6 trillion to $18 trillion. So they're buying just a boatload of securities. Looking at it in terms of percentage of GDP, Japan is the champion here, that they have increased their balance sheet. The Bank of Japan, we talk about it's got a balance sheet of something like 75% of GDP. They own something like 40% of all JGBs issued. So this is huge on the quantitative easing side. Now, I take the view that quantitative easing has been relatively successful in getting short-term growth. So what we see is certainly the first round of quantitative easing by the Federal Reserve. There were 3 rounds of quantitative easing. The first round was, in my view, totally necessary. You didn't want to repeat the mistake of the 30s, have the banks seize up, have the whole system implode like we had in the 1930s. So the Fed was right to come in there rather aggressively to stabilize financial markets, to prevent the contagion from just taking one institution down after the other. So in that sense, it was successful. We could have really had a great crash. That was forestalled. I'd say that as well, what we've seen is the United States has staged a moderate recovery. It's very slow by historic standards, but nonetheless, the United States now is 10% higher than it was at its previous peak. And what strikes me is if you compare the United States, which is the blue line at the top, 110, with that of Europe, which is now just back to 100. So basically, over the last 8 years, Europe has managed to get back to its previous peak, while the United States is 10% higher. To me, that is sort of reminiscent of what happened in the 1930s with the countries that left the gold standard first were the ones that did less bad than the others. I think that this is the same kind of thing, so that the quantitative easing has had short-term effects that are reasonably, if you compare the United States to the others, the United States has done well by being the first to really pump up its economy with quantitative easing. That's the good part of the story. The bad part of the story is that quantitative easing has enormous unintended consequences. So essentially, what the whole idea of quantitative easing was to juice up asset prices, to get people to take additional risk, and that is essentially what they did. That is the main channel through which the quantitative easing worked. But in the process, what they've done is they've created very large asset bubbles. I'm not talking about the stock market. I don't have particular views on the stock market, but certainly if you look at the bond markets, you've really got huge asset price bubbles, and you've also compressed credit spreads to levels that don't really reflect the risk of default, and that going forward can really be problematic. This chart, which isn't my chart, I think summarizes well how quantitative easing had got bad side effects. The one is it does through wealth distribution. Those people who owned assets did very nicely. The ones who own financial assets have done very well over the past 8 years. The rest of the public hasn't, and that is really driving the politics, that we've now got to live with, not just in the United States, but globally. You get high inequality, you get dissatisfaction. It leads to bad results in terms of economic management going forward. The second is the question of resource misallocation. That is that what you're doing is you're allowing people access to finance who shouldn't really have it. You're charging them far too less, so the market isn't really working in terms of allocating capital. So we get poor allocation, we get inefficiency through that side. And then the third is what we do is we create asset bubbles, which eventually, once the asset bubble bursts, once the credit bubble bursts, we're back to square one, and then we want to go back and do more monetary policy stimulus. So just quickly to run through why I think that we've already got asset price bubbles or why we've got credit compression. It's just noteworthy that what we've got is what we had until recently, because we've started the correction process. Until recently, roughly a quarter of the world's bonds were at negative interest rates. And as Alex said, this makes little sense, because if you've got negative interest rates when the central bank target is 2% inflation, what you're talking over 30 or 40 years, if you've got a bond like that, it means that they're telling you that they can guarantee you that you're going to lose 50% of your assets in real value, which doesn't make sense. The other thing about the quantitative easing is what it's done to global debt levels is that this chart from the IMF shows that instead of deleveraging the global economy from 2008 on, when the last credit bubble burst, what we've done is we've increased the amount of debt in the global economy. So we're now looking at something like 200% of GDP, just before 2008, we're now at something like 220% of GDP. So there's far too much debt around, and it's priced at levels that really don't reflect the risk of default. This chart, just is an indication of the high yield market, but what I would just stress is that credit is mispriced, not simply in the United States high yield market, it's the emerging markets, countries like Saudi Arabia with a 15% of GDP budget deficit manages to raise $17.5 billion at ridiculously low interest rates without breaking a sweat. You've got problems in the European sovereign debt market as well. So you've got a lot of money being lent to places that have got stresses. When those stresses play out, you'll really see trouble. And then I'm going to put up a slide that Alex Pollock is familiar with, because it's a slide that he's done, which just shows a different way of looking at this, is looking at household worth per capita, looking at it against a trend. And if you see that the trend rate of growth now is 1%, looks like you've got a bubble in asset prices, similar to what we had before 2008. I'm of the view that this is not going to be with us for very long, particularly if we do see the Fed starting to raise interest rates. We're going to see this all unravel. And that's why I don't believe in this historical business that, because in the past we went from low to high, we're going to go again. I think that as the bubble bursts, we're going to be at very low interest rates for a very long period of time. So my real concerns are that you've got countries like Italy, which are a real mess, in terms of banking crises and too much public debt and political dysfunction and low growth and lack of competitiveness. The whole kabang, once interest rates start rising, that is going to come unstuck. And you're now talking about a country that has got $2.5 trillion of sovereign debt, the third largest sovereign bond market in the world. If Italy plays up, that is a global event. It's a la Lehman event. Another aspect of the Trump budget policy, which is causing real problems, is that as he causes the Fed to tighten, what happens is the dollar surges. We are now at a 13-year high on the dollar, with the dollar got a lot further to go, and that causes real problems for a whole bunch of emerging market countries that have borrowed too much in dollars, on their corporate side. This is just a chart, that I think one should just keep an eye on the next few months. It's money leaving Italy at a rate that we haven't seen since 2012. That the amount of capital leaving Italy now is something like $360 billion is their balance in Target 2 of the ECB. The Germans aren't going to be too happy with the political vacuum you've got now. 6 months, we're going to really see a lot more money coming out of Italy. So the last point I'd just say is that when, my view is, but maybe it's too optimistic a view, is, when the whole house of cards comes down, when the Fed's got to come back in and do something, to hold things together. My hope is that we don't go the quantitative easing route, which has got those negative consequences. My hope is that somehow we engage in helicopter money, where what we do is we get a fiscal stimulus with a we get a fiscal stimulus with the Federal Reserve financing it. And that way you don't get the distributional problems, you don't get the credit problems, you don't get the asset price problems, but I guess central banks have a tendency. Rudy Dornbush once said of the Mexican central bank that he could understand them making mistakes because, after all, they were human. But what he couldn't understand was the same people making the same mistakes time and time again. And it looks like the Fed might be making the same kind of mistake. So I'll leave it there, Alex.
Thank you, Desmond. Of course, financial history is different people making the same mistakes over time. I am now taking on my role as the proxy for Jim Grant, and I want to share these thoughts that he sent me today. Says Jim, rarely is anything new under the sun of finance. I guess that goes with your slides, Dick. But today, we're beset by novelty, writes Jim. As Dick Silla knows better than I, negative nominal bond yields are a 5,000-year first. I heard you say 4 or 5,000, so
yeah,
what's 1,000 years among friends?
Hammurabi was 4,000 years ago.
Another first is central bank management by former tenured economics faculty. And so is our universal system of fiat money. Personally, I may add a personal comment. I think that point cannot be too strongly stressed. Over the last several decades, a universal system of fiat money is a vast financial experiment. We live in a time of radical monetary experimentation, writes Jim. The experiments may not turn out as the theorists expect. Interest rates are the most important prices in capitalism, discounting future cash flows, calibrating credit risk. I take it that prices are better discovered in the market than administered from on high. Interest rates, like chickens, should be free range, but ours are increasingly cage grown. Ultra low interest rates, right, Jim, tend to push business failure into the future. I think it's one of the things about Japan, Paul, by keeping the interest rates at zero, you keep the unsuccessful investments alive.
Zombie banks, yeah.
Yeah. Ultra-low interest rates tend to push business failure into the future. Availing themselves of concessionary financing, marginal companies live on and on. The normalization of today's interest rates may have consequences that the Fed isn't banking on. Jim goes on to write, bad banking subverts good money because financial crises force radical monetary innovations, which lead to distortion and debasement of the currency. Such crises have been recurrent for 200 years. Here's my proposition. The trouble with money is credit, and the trouble with credit is people. Jim elsewhere wrote, all it takes to have a bubble is a critical mass of human beings. A line I like a lot. Says Jim, Donald Trump is tail risk on 2 legs, by which we journalists mean good copy. And we at Grants eagerly await the next 4 years. With America First as the administration's motto, that could just as easily be Janet Yellen's. The central bank remit encompasses the 50 states only. In the Federal Reserve Act, emerging markets or any other markets, such as, say, China or the euro area, remain unmentioned. The Fed is the central bank of the United States, but the dollar is the currency of the world. We actually Desmond and I had a conference on this problem of the Fed as central bank to the world, which Jim mentions here. And he concludes, I think foreign events will color U.S. monetary policy in 2017 in ways that will surprise us. So thanks, Jim, for sharing those events. Let me give the panelists a chance to add anything or react to anything anybody else said, say 2 or 3 minutes max. But Dick, any further comments?
Oh, just one brief comment. Desmond was talking about asset bubbles, and I like historical analogies. You weren't old enough to remember those very low T-bill yields of the 1930s, but maybe some of you in the room remember the 1972, late 1972, when Nixon defeated, George McGovern rather handily, I thought. But somehow or other, there was a big wave of optimism. But now we're talking about Dow 20,000, on the verge of that. Well, the Dow closed above 1,000 for the first time in the period right after Nixon defeated McGovern in 1972. There was a lot of optimism. It reminds me of right now. There was some election made a lot of people happy who deal in stocks. And so there was like a month-long and maybe a month and a half rally. And then guess what? 73 and 74 were terrible. So we have a pretty richly valued market now. It got even more richly valued after Mr. Trump. And some of us would not be surprised. You mentioned, or Jim mentioned, I guess, that the foreign events might have some, we know 73, 74, well, we had the Watergate crisis, we had the oil shock and so on. I think something else might come up, maybe from overseas in the next year or two that will make 2017, 18 maybe somewhat like 73 and 74, where the market might go down after reaching a benchmark.
Thank you.
So I was, the last few days, looking for clever quotes to end my presentation with, and I didn't get to show you my Henry Ford one, but
Well, show us now.
no, one has become even more appropriate. So there's this this cowboy philosopher, songwriter, country music star who ran for governor of Texas named Kinky Friedman. I don't know if you ever heard of him. He ran for Texas governor. And he had a quote that says, if you're patient and you wait long enough, something will usually happen, and it's usually not good.
That's life, as they say.
I thought that was pretty appropriate. I'll turn it to Desmond now.
I guess one thing I would just add that is of concern to me, as it relates to monetary policy and the exchange rate, with Donald Trump, is that there just seems to be a basic contradiction between the two strands of what he's wanting to do. The one hand is he's wanting to have a very expansive budget policy, and that is forcing the Fed to go into tightening mode, forcing the dollar to rise, and that makes the United States not very competitive. On the other hand, he's wanting to level the playing field by introducing a whole lot of import restrictions. He's wanting to label countries currency manipulators and decide. What I'm trying to say is that the inconsistency is on the budget side, if you drive the dollar high, it's really going to force you to be more restrictive on the trade policy, and that's really got to be a huge risk to the global economy, that we can really get involved with trade wars with China. The second thing on the dollar side that is of concern is the Bank for International Settlements has identified as one of the really big risks to the global economy the fact that over the past 8 years, corporates in emerging market countries have borrowed as much as $3.5 trillion denominated in dollars. So, all of this is pretty, to me, seems to be pretty scary. If the fiscal policy goes through, we're going to have tight monetary policy, we're going to have a high exchange rate, and that really heightens trade frictions globally, which isn't a good idea, and it puts a whole lot of important emerging market countries in a difficult position. Obviously with the Chinese, they really are in deep trouble, because they damned if they do, they damned if they don't, in terms of what they do with their currency. But as their currency is sort of tied to the dollar, if the dollar appreciates, they're appreciating against everybody else. So, and if they move that currency, they just give more grist for Trump's mill that they're manipulating their currency. So, I'm kind of pretty concerned where we are.
Thank you all. Ladies and gentlemen, we're coming to the time when we can get your questions. May I remind you to please wait for the microphone. Where's my microphone? Here, please. You don't have my microphone. There we are. Okay. Please wait for the microphone. Tell us your name and your affiliation and ask your question. If you spend more than a rather short period of time pontificating in advance of your question, the chair will remind you that it's time to come to your question. How'd you get that microphone before I called on you?
He handed it to me.
I'll call on Bert.
Thank you. My name is Bert Ely, and I'm a banking and monetary policy consultant here in the D.C. area. Professor Silla, those charts of yours are great. It's been a while since I've looked at them in your copy of in my copy of your book. What I find interesting as it relates to today's discussion is that over time there's been an enormous amount of variability in interest rates, and my sense is that for much of the time in most of the countries, these rates were basically driven by market forces. Most of those years we did not have central banks. My question is simply this: why is it necessary for the nations of the world to have central banks influencing interest rates? Might the world actually function better if markets set interest rates the way they did for so long?
Well, I mean, I'll give you a historical answer, and it's based partly on my studies of the U.S. history. We had central banks don't always set interest rates. They do other things, but the traditional central banks, I guess, starting with the Bank of England and Bankrate in the 19th century, they used interest rate policies. But I think central banks, even if they're not having an active interest rate policy, or maybe they shouldn't have an active interest rate policy, but help to stabilize economies. In the U.S., if you just, what I did once, very simple experiment, was, we had two sort of central banks, maybe with a small c, early in U.S. history. My friend Hamilton started one in 1791, the first bank in the United States. It lasted 20 years. We got rid of it for political reasons. Albert Gallatin, Jefferson's Treasury Secretary, really liked the Hamilton's bank and wanted it to be renewed, but the state bankers didn't really want to have a national bank. So we got in the War of 1812, and 5 years later, they decided we really did need it. So they started a second bank in the United States. And then Andrew Jackson got rid of that one. So for 40 of the first 45 years of U.S. history under the Constitution, we had a central bank. Then we had 7 decades without one, and then we got the Fed in 1914. So there's periods with and without a central bank. If you go and count the number of financial crises, you'll find that there were twice as many financial crises when the country did not have a central bank, maybe one every 10 years or so versus one every 20 years, as when we, twice as many when we did not have a central bank as when we did. So I think history, and you could say the same thing about the Bank of England. When the Bank of England actually began to behave like a central bank, the British had many fewer crises than they did before the Bank of England behaved like a central bank. So I think history's record is that central banks, regardless of whether they're using interest rate policy or not, tend to have a stabilizing influence. Lender of last resort, interest rate isn't the only thing they do. They act as lenders of last resort. So I think the historical record says central bank is a sort of stable. The U.S. has had kind of constant growth for 220 years until lately.
Does that rationalize government central banks influencing interest rates? Is isn't that a separate fund? Couldn't you?
Yeah, that's what I'm saying. That you're right. I think you could have the stabilizing influence of a central bank without it having a conscious interest rate policy. But the Bank of England ran this bank rate policy. They used to say a bank rate of 8% will pull gold from the moon or something like that. So maybe the record of interest rate management by central banks is not great, but it's had some pretty good. If there is more stability, interest rate policy might be a part of that. And we know in the United States history, a lot of people wrote when the Fed first came in, we didn't have these big seasonal movements in interest rates anymore. It used to be in the fall, money markets would tighten because the money was drawn out of money centers like New York to move the crops, they said. It had to go out to all the banks around the country. And the New York money market would tighten up, and that's why you often had financial panics and stock market crashes in September and October, which I think are still the two worst months. And so when the Fed came in, there wasn't this big seasonal in interest rates anymore. So that was interest rate policy, just smoothing the annual movements of interest rates. And that seems to be a good thing. And I don't know, I'm not a big fan of pushing interest rates down to zero for all the reasons that we've talked about here today. But I think to say they shouldn't be allowed to have any effect on interest rates is like going back to the world when you didn't have a central bank, and that was a less stable world.
Other comments?
Yeah, I agree that the central bank holding interest rates at zero, is not a good idea. But I think one's really got to look at the political context in which that occurs. If you've got a big financial and economic downturn, and you've got the Congress, for whatever reason, not wanting to engage in fiscal stimulus, then what you have is you have the central bank in a very difficult position. They feel they're the only game in town. What's the instrument? They've only got the interest rate instrument buying government bonds, and what they've done is they've done that to the limit. But it's not. I'd agree with you that it's not desirable. What would be preferable would be to have a properly designed fiscal policy, that takes a lot of the burden away from the central bank. The only trouble is that we're now getting the fiscal policy turning stimulative at exactly the wrong time for it to do so. So it's really kind of complicating the Fed's life. Just at the time that the Fed should be tightening, the fiscal policy is loosening.
I'm going to take a piece of this. So I think what Dick and Desmond say is definitely true, that the central bank has helped stabilize. But it's also possible that they've backed themselves into a big corner, right? All they've done is push off the popping of a bubble. They refinance. I don't understand fundamentally how you can fix a debt bubble problem by having more debt. Now what they've done is they've allowed some of the players to refinance debt at lower rates, get their balance sheet, but the government's brought the debt on the government balance sheet, and ultimately the taxpayers, the corporations, and the households are responsible for that government debt. If this bubble breaks the next time, I'm wondering if that's not what happened to the Roman Empire, right? They had those zero interest rates, the bubble break.
No, 4%.
4%, and then nobody was willing to buy. As the barbarians were coming down, they said, "Come on, buy some more bonds. Interest rate 6%, 8%. Come on, Dick." Said, no, we're not going for that. I wonder how long they can play this game. You're kind of just, you're allowing zombies that probably should have
You see the barbarians are coming down from New York right now, and rates are going up.
They are. They come up from Florida too, some weeks. But yeah, so I wonder, how much we're just not moving. We have to pay the piper some point. I wonder, can you really just get out of it by printing money or Desmond's helicopter money? And we won't go into that now. We don't have time. But Desmond and I always are not always in agreement about what helicopter money means. To me, that debt chart and the fact the Fed bought it is essentially helicopter money, where the government debt grew like crazy and the Fed's balance sheet grew like crazy, but some people think it means something different. Anyway, I'll leave it at that.
I'll just say thanks, Bert, for a very stimulating question. Which, yes, next question.
My name is Bonnie Wachtel. I'm in the investment business. Well, I've been coming to these for a long time and really enjoy the bath of desperation that always comes out of panels that Alex and Desmond are on. So while waiting for the end, let me put a little hypothesis in front of you and ask you to react. As I understand the Trump program, it is principally based on removing regulation and putting out a more sensible incentive-based tax policy. In other words, doing exactly the right thing, exactly the kind of thing that Italy should be doing to fix its economy structurally. And as for the infrastructure spending that I think we're all so concerned about, a lot of attention, at least through lip service, is being given by guys like Wilbur Ross, that it's only going to be the good kind of infrastructure spending, the kind that actually creates wealth, not bridges to nowhere, and public-private partnerships, and getting a lot of work from, every dollar we'll pay. So the first question is, do you think there is a prayer of a chance that that's actually going to occur? But also, let's assume for a moment that it could occur. Isn't that exactly the right thing to do to allow the Fed to get out of this difficult situation that it's gotten itself into, where there's no confidence and growth is so slow, largely as a result of that? That is my question.
I think we just heard a question about the difference between theory and practice. Perhaps.
I think deregulation is really important, and I hope we see some of it. I mean, it's hard to know at this point. It's too early to know, and tax changes to the tax law, we need it. But I think Desmond's a more pessimistic view. It relates around the spending that I think he thinks strongly is coming, and at low rates of unemployment. So, but I'm with you. I think that's the right way forward. The infrastructure stuff. I'm a little bit on Desmond's side. I don't know how much of it we can afford. I mean, we have a lot of debt, and I mean, if things start growing, then maybe we can afford more. But it was a big promise of the campaign. So.
I think I would agree with you, and I'm glad you didn't put me in the gloomy gusses. Alex and Desmond are the gloomy gusses here, and I don't know if Paul's an optimist, but I'm a little more. And here's what I would disagree with Desmond on. I think, yes, the unemployment rate they're announcing is down to 4.6%, but the labor force participation rate is down. Some of these jobs that are counted as jobs aren't jobs that people really like. And I think that things could have. There's more slack in the labor market, I think, than the unemployment rate might make you think. And so I kind of think this infrastructure spending program, yes, let's hope it's on good projects. I just think there's so many. I live in New York City. We used to call our Senator D'Amato there Senator Pothole. Because there were a lot of potholes in the city. And even after good government under Bloomberg and all that, there's still a lot of potholes there, and the paint is falling off the subway ceilings. And there's just a lot we could do in this country to fix up the infrastructure we already have. We don't have to build bridges to nowhere. And I think that, I'm much more optimistic about the positive effects. And I always point back to the 1930s, when all that wasteful spending on TVA dams and Boulder Dam, Hoover Dam, whatever they call it, Grand Coulee Dam, even fixing up putting picnic shelters in the state parks around my neighborhood where I grew up around Chicago. Those things are still there. Those were not wasteful government spending; they were investments. And I think we ought to think about some of these infrastructure projects as long-term investments, not wasteful government spending. When I hear people say, I'm worried about the infrastructure spending, I think they sort of buying the argument that almost all government spending is wasteful. I don't think history shows that at all. I mean, the Erie Canal was a wonderful project for New York State to take on. And there were other projects in American history. All government spending is not wasteful government spending.
Caused a housing crisis and a banking panic. The Erie Canal.
No, Jackson caused that.
It's very difficult to argue with the fact that the United States needs tax reform. It's also very difficult to argue with the fact that the United States needs a lot of infrastructure spending. All of that will have salutary effects. The basic point is are those going to be financed? That is the key question. And we're not talking about small changes. The estimates that are scored, go around. The tax cuts that we're talking about are like $5 trillion over a 10-year period. And what Trump is hoping is that somehow the United States economy, instead of growing by 2%, is going to grow by 4%. Well, if that proves wrong, and I old enough to remember the Reagan experiment, didn't end too happily from a budget point of view. The difference here, though, is that this experiment is being done not in the middle of a recession. It's being done when we're pretty darn close to full employment. We can quibble about the labor market statistics, but what the Fed is already seeing is it's seeing wage pressure, which is telling you that you're really close to capacity. This isn't the time that you should be juicing up the economy with a big fiscal push, and I'm afraid that is what we're going to get, and that is going to cause a lot of problems.
It may be the way to summarize this, and thanks for another good question, is that it's time that the mood is for another experiment. So we had 8 years of central bank experiments, I recall, always with optimistic forecasts. If we just do this another year, the fundamental real growth and productivity will increase. And all of those forecasts basically were wrong, but they kept doing it. And if you can get the key to accelerated real growth, that's the key to a lot of things. And we know what the key to accelerated real growth is. It's get as much market as possible and as little central direction as possible, in my opinion.
Whatever happens, I'm sure you'll keep having panels.
We will be here. Whatever happens is good for us panel givers. Other questions? Yes.
David Brazel, an economist here in town. I guess I'll add a little more gloom to Desmond's view. If you look at the Ways and Means Committee, the prime tax bill that is now being discussed up there is as a destination tax bill, which means we essentially are taxing imports and taking away taxes on exports, which will require a large appreciation in the dollar on the order of 25% or so in order to achieve equilibrium. And so if you're worried about the impact of increasing value of the dollar on the world economy and dollar-denominated debt elsewhere, I'd love to hear your comments on that. Also on Paul, interest rates are not just the current interest rate is the important thing that goes into an investment decision. I would also argue that future, or the expectation of the future rates, are very important. And while we've had low interest rates these past years, we've also, everyone's been wondering really about when they're going to go back up again. And so the expectations are that you're going to be facing higher interest rates in the relatively near future, and therefore you can't base your decision on whatever the current rate is for the most part. And I believe when Alan Greenspan was here, what was 2 weeks ago, he was noting that investment in longer term in capital was falling, which would indicate that that was a more important perhaps ingredient in those kind of decisions, rather than going to some kind of non-efficient decision criterion like hurdle rates. I think there's some other explanations you could choose. And so I'd just love to hear your comments back on those.
So there's a question on another possible push on the dollar. Desmond, any comments? And then Paul, any comments on the hurdle rate question?
Yeah, I'd buy that can be an additional factor affecting the dollar. The reason that I think that the dollar has to go a lot higher is that monetary policy is so out of sync between the United States and the rest of the world. So Japan and Europe, dealing with very anemic economies, are still engaged in a huge amount of quantitative easing. When we're now beginning an interest rate hiking cycle, and that interest rate hiking cycle is going to be even more pronounced if Trump gets his way, on the tax, gets his way on both the taxes and the spending side. The market is already incorporating a lot of this, that we've already seen somewhat of a bloodbath in the bond market. You've gone from 1.5% to 2.5% in a very short space of time. And what you're also seeing is you're seeing spreads, that the Italian spread is already gone up from something like 50 basis points to 200 basis points against Germany. So you're already getting the correction in the market side. So I think there's going to be plenty of dislocation in 2017.
So to come back to your point, in the Greenspan event, I think what Chairman Greenspan was arguing was that there was a drop. There has been, it's not only investment that's been weak, it's been especially weak in investment that has a long maturity investment. And I thought he was arguing that was an uncertainty effect, that there was a lot of uncertainty because of the buildup of entitlement programs and the promises that are made there, and how are the policies going to evolve to handle that. And Alex and I did a piece on negative interest rates a while back, and one of the things I didn't have really time to talk about today is this option to wait. Corporations, when a central bank lowers interest rates to 0 or negative, it's really telegraphing the fact that they're panicked. I mean, and they always preface it by saying, we really don't want to do this, but if we don't do it, the world might end tomorrow. We're going to save you from the Great Depression. I'm saving you from the Great Depression. Well, they're telegraphing huge uncertainty. And so while they are lowering interest rates, they're generating this climate of panic in some way, right? We've never done this before. Interest rates have to go down to minus 75 basis points. Well, corporations, there's a big literature in economics about the value of the option to wait. If you have the option to invest in a machine today, well, you can put it off till tomorrow or the next day. And it's kind of like the Fed for the last 8 years. We think we're going to raise rates, but we're going to wait to see the data. So the corporations say interest rates are really low. There's some projects we could do today, but there's all this uncertainty. So we'll wait for the data to come in, and we'll wait. So the option to wait really becomes valuable when policy is kind of set at panicked levels and nobody really knows what's going to happen. Businesses don't have very much clarity on the future. There's always the term structure to read off what people think long rates will be relative to short rates and play it that way. But when there's this huge sort of amount of uncertainty, and it's reflected in the way the central bank sets policy, and even in their, even in the way they announce their decisions, it's the weakness is unprecedented. We missed our targets again, but we think, we'll wait for the data to come in to see if we'll raise rates. So that's another thing that drives this problem, and I'll just leave it at that. But yeah, I agree with you. There's lots of reasons why.
Well, one additional comment: when the central bank is itself buying a few $1 trillion in very long bonds, it's unclear what the long rates mean.
That's true. Yeah.
Hang on. Yes. Wait for the microphone, please. It's coming right there.
Okay. Thank you. I'm Paul London. I wrote a book here at AEI about 10 years ago about inflation and competition. I have a friend who has been a very successful investor in real estate for a very long time. And he said to me some years ago, he said, I wait until I see interest rates starting to rise. And that's when I borrow a lot of money, because while interest rates are falling or they look like they're going to stay low, he said, I don't borrow, but I borrow when I see the rates starting to rise. And I'm wondering whether there's some of that phenomena. People are feeling much better about the economy now for some reason. So that's one question. The other thing is I have not been here over the last a couple of months, and I'd love to hear some of this discussion that you all have about helicopter money. It's a term that keeps showing up, and I don't quite get how it works, so I'd love to hear a little bit of it between you, if you don't mind. Thanks.
Okay, 2 questions. Thanks very much. The Competition Solution, was that your book?
Yes.
Yeah, great book. Thank you very much for that, and for the questions. Somebody want to take those?
Desmond, you want to give him your version of helicopter money?
Yeah, but first,
Let's start first. Let's
let
take
me
the first
just,
question first.
the interest rate, I think who am I to argue with somebody who's a successful investor, but this time might be a little bit different, that if interest rates rise in the United States, I think that the problem oftentimes in the United States is you look at the United States as if it's an island, not in a global economy. And what rising interest rates are going to do, you're seeing it with the dollar already shooting up, is it's going to be drawing money out of the emerging markets, out of a whole bunch of other places. It's going to be causing credit risks to widen. So, it needn't be a good sign that this is a great harbinger. It's what is a sign. The reason that the markets are doing this is because they're anticipating that fiscal policy is going to be very expansionary and the Fed's going to be forced to raise interest rates. But that doesn't necessarily mean it's going to end well. Just in terms of helicopter money...
Excuse me, Desmond, excuse me, but you don't support keeping interest rates at zero. And you're pointing out the problems when they go up through the foreign exchange market, which what the conclusion of that is the Fed has painted itself into a very difficult corner, I think.
Let me talk about the rising interest rates. So there was a pretty well-developed literature in economics, and you probably are familiar with it, that would argue that the slope of the term structure was a predictor of growth. So when the term structure was steep, people expected a lot of growth. So it might make sense that when people see long rates start to rise, as you said, people are getting more confident in the future. It is sort of a prediction that we think growth is going to be good. So and if you have the option and you have your crystal ball is good enough, you might think that the start of the rise in rates is going to continue because there is a lot of autocorrelation in the way interest rates behave. It kind of makes sense, and it kind of works. Academics have played with this idea. Now, the one caveat is the one Alex just mentioned. The central bank owns a lot of long-term debt now. So, do those markets work in the same way? Maybe they're even more sensitive now because the Fed holds so much and the part that trades is smaller. I don't know. I don't have a good view on that, but it makes sense why something like that, that might be the economics behind it.
The Fed, I think, is in a difficult position, because they've really got to tread a really very delicate path that if they don't raise interest rates, there's the risk of inflation. On the other hand, if they raise interest rates too quickly, they can cause a global unraveling. So there's a bubble out there, and the bubble bursts. So my view is that what we'll see interest rates rising for a while, and then we'll be back to 10-year treasuries at around about 1%. That's once this thing bursts, I don't see how you're not going to get to that position. Just in terms of helicopter money, that might be somewhat of a misnomer, because basically, Friedman started this all with the helicopter flying over the United States, dropping money, people picking it up, spending it. That's how you'd really get the economy going. But basically, what it is right now is it's a fiscal expansion financed by the central bank with the understanding that they don't expect to be repaid. So in other words, what it is really a fiscal boost. You can see how it works. That if you just go give a whole lot of money to low-income people, they're going to spend that money, and if the Fed finances it, you don't have an offset with interest rates rising. So it's a net boost to the economy. The reason that I think it's attractive, more attractive than the experiment we did with quantitative easing, is you don't distort the financial markets big time the way in which the Fed has done it, and you don't have the problems with the political side, that some sector of the population does extremely well, the other sector does very poorly, and that then begins driving the politics, and who knows where that is going to take us. So helicopter money to me would make a lot of sense. In the next time we have a big bust. Let's not go that. I'd be really very much against going the quantitative easing route, because I just think it's really created a big credit bubble that'll burst.
My opinion, quantitative easing is helicopter money. The only difference from a practical point of view is the government sells the debt to the financial markets, and then the Fed buys it out of the financial markets. So there's only an intermediary in there. It just goes through the markets first. And if the Fed pulls all the debt out of the financial markets early and the government sells it to the it ends up in the Fed anyway. And if you look at the indebtedness chart I put up there, the only debt that grew relative to GDP over the last 8 years is the government share of it, and a lot of it was bought by the Fed. I mean, QE is basically helicopter money. Now, Desmond says, no, that's not true. The Fed has to buy it directly from the Treasury. It doesn't really have to, all it has to do is keep the level the same, right? If the Fed just keeps it out there, then it's permanent. And the Fed takes its interest rates and whatever it doesn't spend on, whatever it spends money on, it gives it back to the Treasury. So net, essentially, there's not an interest rate charge if the Fed buys the debt. So, but in my opinion, practically speaking, the only difference between QE and helicopter money is the Fed buys it directly from the Treasury rather than buying it through a financial intermediary first. It goes to the markets first, then the Fed buys it. So I don't see any difference really.
The quantitative easing is what the Fed is doing is it's buying debt that has already been issued. It's in the secondary market. Helicopter money is the Fed financing new government spending. So that's a total difference.
The government was financing new spending while the Fed was pulling it out of the market.
No, they weren't financing spending. Pardon?
We didn't always need to use the Fed. We used to have the government just issue itself, basically raise money or print money.
No, you don't want to have pressure on interest rates rising, because that would then be an offset to your government spending.
Yes.
So what you're wanting to do it is in a way
It's all
that you
just the
hold
net
the
change,
interest
that's
rates
all.
at a low level and you get the government spending going.
It's good. I think we're going to call this one. Thank you for an excellent question. Yes, here. Please wait for your microphone.
Barry Wood. I want to ask you if you think quantitative easing is the correct term for what you've described, because it's a very curious term.
Yeah.
And I wonder also if quantitative easing, whether it's Desmond's version or yours, Paul, is really monetization of debt.
Yeah.
Of course it is.
If the Fed
That's what they don't want to call it. Excuse me for jumping in, Pam.
No, you're right. If they don't ever roll it off, it's monetizing the debt. If they let it roll off, then it hasn't permanently changed the level of money in the system, because they change bonds into deposits. Deposits of the either way, deposits either of the private sector, deposits of the Treasury, one way or the other. So yes, it's monetizing the debt, and especially if they don't ever let it roll off. If they let it roll off, then it's kind of a temporary monetizing of the debt. But as far as I know, they're planning on not letting it roll off. They're rebuying debt as it matures, as the last time I knew what they were doing.
Any other comments? Okay. Yes, in the way in the back here.
Hans Roger VB. The application of the 1999 version of the Taylor rule called for the Fed's fund rate at somewhere close to 9.5%.
Excuse me, I'm having a little trouble.
Yeah.
Yes, sorry,
hearing you.
it's
Can
my
you speak
microphone
up?
or my voice.
Speak louder.
Yes, okay. Hans Roger VB. The application of the 1999 version of the Taylor rule called for the Fed's fund rate at 9.5%, somewhere between 2009 and 2002. I mean 2009, 2010, when the Fed embarks on QE2. I guess the question I wish to pose to the entire panel is, which set of alternative policy prescriptions would you have proposed in order to provide demand-augmented support to the macroeconomy, which was the argument which the Fed made at the time and which the ECB also made in 2014?
Okay, so what if we don't like the experimental policy for 8 years, what do we like instead?
The alternative.
What's the alternative?
Historically speaking.
Well, that's the point that I've been making that hasn't been brought here, is the idea is that what you're needing is a fiscal policy, a very well-directed budget policy. So, what we had in 2008 is we did have a very big stimulus plan, but it was extremely poorly designed. You weren't getting as much bang for the buck as you should have done. So, really what you're wanting to do is you're wanting to direct the money to people who are really going to spend it rather quickly to get it into the economy quickly, and then once you've jump-started the economy, you're supposed to be reversing that process. So that would be the alternative. It's kind of what's occurred in my view is that too much of the burden of trying to support the economy was put on the Federal Reserve. And as I said, they succeeded short term, getting the economy to grow, getting unemployment to back down to 4.6%, but they did it at the expense of setting up, the next bubble and the next bust.
Other comments on that?
Well, I think the Fed's reaction really wasn't Taylor rule oriented. It was really to stem a run on the financial system. So I think when you're dealing with a financial system that has a huge run and the money supply is shrinking, I think that's a different situation than a Taylor rule where everything's stable and so monetary policy as they knew it before that wasn't the way to think about it. And
but the Taylor rule was telling them that they should set interest rates at -4 or 5%.
Minus 9.5 actually in 2009, 2010.
Minus how much?
It was minus 9.5.
Sorry,
minus 9.5.
I don't like
Minus
to
9.5.
exaggerate.
Minus after the crisis, but much higher in the run-up to the bubble.
Well, I mean, I don't think interest rates of minus 9.5% would have helped anything, as I mentioned. I don't think, I think you create all kinds of unintended consequences when nominal interest rates get near zero and below. And so I don't think the Taylor rule, I'm not an expert, you should ask John Taylor, but I just have a feeling it probably doesn't work in that region of interest rates, at least probably not very well.
If I could add something here, because Dick made a point before about the role of a central bank in a crisis, which is the reason the Fed exists, versus all the time that isn't the crisis, when they're fooling around trying to manage things, not really knowing what the results of their actions will be. And in my opinion, it is impossible to know what the results of the actions will be. So I think it's Charles Kindleberger's line. By the end of the 19th century, the division of labor in banking was established. The private banks financed the boom, and the Bank of England financed the bust. All right, so there's financing the bust, getting you out of the bust, but that's a short period of time, a year or so in the last time. And then there's all the time since, when we're no longer in the bust, when we're getting this extremely distorting, in my opinion, this extremely distorting behavior on the part of all the major central banks for 7 years. So they're not performing their classic financing the bust, getting me out of the crisis. They're performing something very different in the way of trying to manipulate a system which seems to have been unsuccessful. Go ahead, Dave.
I think that they were kind of forced into that in this country because we ran into a stalemate between the president and the Congress. And in Europe, it was more because of austerity. I mean, I agree that we should have had more fiscal spending. Maybe there weren't enough shovel-ready projects, but it seemed to me that we should have had this great push for infrastructure spending program back in 2009 when unemployment was 10% and a lot of those people were construction workers. That would have been the time. I think it's really too bad and we lost a terrible opportunity by talking about having an infrastructure program now in 2017 when we're closer to full employment than we were then. But you couldn't get that kind of spending program whether there were or weren't enough shovel-ready projects in this country. And in Europe, they decided that the key to getting out of it was austerity. So I think, I kind of agree with Alex that these unorthodox monetary policies are very distorting. The central banks were, I think, kind of forced into them by what was going on in the fiscal side of policy.
Other questions? Bert, you don't get another turn until everybody else has had a turn. Yes, right here. Wait for the microphone, please.
Thank you so much. My name is Daisuke Igarashi from Asahi Shimbun. It's a Japanese newspaper. I have a question about BOJ's balance sheet. I think the size of the balance sheet is the highest in the world. So when they try to exit, what would be the biggest risk? And second question is... So
I'm sorry, when they try to exit?
Yeah, try to
their
exit.
own so-called quantitative easing. Yeah.
And the second question is, so you discussed about the helicopter money, but is it going to erode the credibility of the central bank or erode, the independence of the central bank?
Okay, thanks. I think the BOJ will come right to your comments, Paul.
Me?
So, yeah.
I don't
Bank
know
of Japan.
how
How do they
how-
get out of it
I
now
don't know
that
how
they're
they
in
get
it?
I don't know. I don't have a clue. Maybe Desmond does. But yes, helicopter money, is supposed to cause inflation. One of the big mysteries of the last 8 years is why the central banks of the world can't cause inflation. They've tried as hard as they can. They've, high-powered money, is huge. All the they've been trying to cause inflation. They can't do it. So this is the big mystery. And
Liquidity trap.
liquidity trap. Yeah.
Japan's problem's a lot more complicated, largely because their public finances are so compromised and they're on such a terrible debt path. So if you look at Japan, its public sector to GDP is something like 240%, gross. They're running a primary budget deficit of round about 6%. They're wanting to engage in a fiscal stimulus right now. So at some point, the government's really going to have to be restrictive on the fiscal side to correct its, whether it's increasing VAT or whatever to bring their public finances back into shape. And that is really going to make it very difficult for the Bank of Japan to get out of buying all of these bonds, because somebody's going to have to provide support to the economy. I mean, the way in which it'll work, in my view, is that you'll see a very big depreciation of the currency. You'll see interest rates being held, that the objective of the central bank right now is to keep long-term rates at around about 0% for a prolonged period of time. And I think that the central bank will be forced to do that, but how it'll work is it'll move on the currency. You've already seen the currency gone from something like 105 to 117, 118 the last month or two.
So he's giving you the very eloquent explanation. Historically, and I'll ask Dick to back me up, usually it's hyperinflation. That takes care of it.
Well, that is to say utter debasement of the currency.
Yeah, hyperinflation.
Zimbabwe, Venezuela.
Venezuela, yeah.
There is the story of the, I think he was the king of Syracuse, who ran out of money and couldn't pay the debt that he had incurred to his own citizens. So he got them to turn in all of their gold coins by government mandate, which of course we did in this country as well.
FDR.
Right? Yeah.
And he took all the 1 drachma coins and re-stamped them 2 drachmas and then paid off the debt. So that's another way of saying what Paul just said. Other questions? If not, we'll give Bert one more question, a short one, and then we'll adjourn. Wait for the microphone.
Excuse me, Bert Ely again. This is a question for Paul with regard to your excellent charts that you had, and specifically with regard to the increase in the savings rate that you in a number of countries. To what extent are households saving more to compensate for the fact that they're earning less interest on their assets? In other words, if they have a long-term savings goal, if they're going to receive less interest towards that goal, they need to save more, and does that in turn have a negative effect on consumption and investment spending by households?
I think, Bert, that's a possibility, and those were my examples. So I think you can think of three types of consumers, right? The young households who want to borrow, need to buy a house, need to have the kids and the cars, and then there's middle age where they have to, save for retirement and more so. And then you have the old age that are living off their savings. And we've had, the age distribution of the population in Europe and in the US and certainly Japan has shifted way towards you're either saving for your retirement or you're in your retirement. So I think the demographics probably make make that channel and interact with low rates much more important than it was. Although I don't know of any empirical studies to back that up. But that's just I think it's just common sense, really. But it certainly is something that needs to be studied, I think.
Any final comments, parting shots?
Well, just on that, I mean, Bert, you want to take a look at China. I mean, China has like a savings rate of 40%. Apparently, they don't have much in the way of Social Security, or they don't have much of the way of Medicare, healthcare. So people the Chinese people realize they need to save a lot of money. I think the Chinese banking system is giving them kind of low rates too, not much higher than inflation. So I think, you know, that's one of the distortions that Alex talked about. When you keep these rates so low, you distort people's ordinary behavior, and, you know, so China isn't all that different from the U.S. in that sense, that people, you know, lower rates, especially real rates, to nothing, and boy, you got to save a lot for the future.
You either have to save a lot or get a 3% cashback credit card. Spend a lot.
Thank you, ladies and gentlemen, for being with us, and let's thank our panel. Very good. That was a lot of fun.
Yeah, well.